So the government says if we can keep enough money flowing by whatever means over a period of time, people are going to see that the economy is really okay and businesses aren't failing, and they'll start to trust each other and start to lend and transfer money back and forth again. So short answer is that money that was flowing before is not flowing today. So we're bringing in outside money, government money, to keep the wheels of commerce greased. They both aren't together. And when the old money comes back in, then the other money will go back to the government. Thank you. Yes, sir.
The whole problem, really, this fractional reserve banking system that we have, the Federal Reserve, because right now you're allowed to loan out 10 times more money than you have, right?
Correct.
Charge interest on it. So you're loaning out money that you really don't have. You're making money back on it.
Correct.
And then the Federal Reserve, which, correct me if I'm wrong, is basically quasi-private banking cartel, really, which, I mean, has so much power over the entire U.S. currency that, you know, they cut interest rates and then people lend money, right? People get greedy and then it just spirals down from there.
I don't know that I can repeat that question, but what what you said was, isn't the fundamental problem the banking system and the fact that the Federal Reserve is quasi-private and has such control over the money supply? Would that be fair? No. Next question. No. Before we had a Federal Reserve System, before President Wilson in 1913 envisioned a central bank, we had little banks that were failing everywhere in small communities because they were printing their own cash. Every bank had its own form of currency. Well, the banks actually printed it before we had a central bank. And it was horrible for families and horrible for communities and horrible for economies because there wasn't a central banking structure to control the money supply. The Federal Reserve System is run by a board of governors that is appointed by the president and ratified by the Congress. So it's not a private or even quasi-private. They have advisors. I sit on a team that advises the Fed, but they do what they want to do. They're asking us what's going on in the marketplace, but we have no control or direction to give them. And the primary role of the Federal Reserve is to fight inflation. That's what they're raising and lowering interest rates to address is inflation. And that's why rates are so low today, is because there is no inflation in our market system. So if you ask yourself, when will this recovery begin? I'll give you two indicators. One is when Wall Street banks quit worrying about their balance sheets and start worrying about their profit and loss statements again, because then they're going to look for efficiency and innovation. And secondly is when you read about the Federal Reserve on page 9 of the business section, and there's some little note that says they kept rates the same or they raised and lowered them a quarter. That's where they belong. They don't belong on the front page fighting the battles they're fighting today, because they're only supposed to be worried about inflation. But they've had to take on a larger role as economies go into recession to keep them from going into depression. Without a banking system like ours that creates capital by lending out 10 times more than what they have in capital by lending our deposits, if you don't have that ability to create capital, then businesses can't expand, jobs can't be created, technological advances don't take place, everything kind of just stays mediocre. So the system we have today is what really drives the prosperity that we enjoy in this country versus all of the other countries you see around the world. Yes, sir.
Well, you just said that the Fed is only responsible for inflation.
That's their primary role. Well, they're responsible for the money supply. So that's one of the few tools they have, is the money supply. And where you have significant problems is that term you remember back when Nixon was president, we had stagflation. We had inflation plus a stagnant economy, and they didn't know how to address it. They were confused. So as long as you don't have inflation and you got a stagnant economy, then they're able to lower rates to stimulate borrowing, to stimulate lending. It's the Treasury that's putting money into the system. The Fed is putting money into the banking system, but the Treasury is the one that's buying commercial paper and putting their shoulder to the wheel. So as long as we don't see inflation, the Fed has a clear directive to increase the money supply, because that's what keeps the recession from getting worse. If we had inflation, then they're very conflicted and have in the past decided that it's better in the long run to fight inflation than it is to fight the recession. So luckily they only have one battle on their hands right now, so they would go after that one. But in their mission statement, they would be interested in keeping inflation in check for the long haul. Yes, sir.
In the beginning of your speech, you said that guys from Wall Street are in charge of this crisis, and so this is not the fault of the Fed. But then during your speech, you several times mentioned such definitions as excessive leverage and excessive liquidity. But as I understand, this is a part of monetary policy, and this is in charge of Fed. So don't you think that Mr. Greenspan and partly Mr. Bernanke is also in charge of this situation which we have now?
You know, I think that Greenspan has been criticized on Capitol Hill for keeping interest rates too low too long. But the leverage wasn't created by the Federal Reserve. The leverage is created by investors. And 10%, 10 times isn't the leverage I'm talking about. Some of these were 90 times levered, these investments that Wall Street was using. And they were bringing their investors in as lenders, not the banking system, but private investors, hedge funds that were very leveraged that got in financial trouble. They're not the purview of either the Fed or the Treasury. These are instruments that were created on Wall Street. I think we'll see regulation going forward to keep that from happening again. But if you just look at, let's go back to Margaret Thatcher when she became Prime Minister of England. She said, we don't need a GSE, we don't need a Fannie Mae or a Freddie Mac. We'll let the private sector control interest rates by being the secondary market for mortgage loans. So she did away with their GSEs, and we still have them. We still have Freddie and Fannie Mae. And in Europe, you'll find interest rates are higher, but you'll find housing prices are lower. In America, we have lower interest rates, but higher housing prices, and that affordability index is exactly the same. So if Greenspan gets criticized, it's because he kept interest rates so low that we had this housing explosion where, you know, there's a lot of people in Bozeman, this is their second home because they have a first home somewhere else. It's because interest rates were too low. So I think that's the criticism that he's received. But, you know, if you're a contractor or if you're a realtor, those were pretty good times. So you're sort of applauding Greenspan on the sidelines. But he was fighting something else, and this one kind of got away from him. You want to take one more shot at me?
Yeah, well, so you said the Fed's supposed to regulate inflation.
Yes.
But so the $700 billion bailout.
Yes.
Where's it going to come from? Basically, the Fed's just going to print it out, right? The more money you pump into the system, the more the value of the dollar declines.
I will tell you that in January, the Treasury Secretary Paulson met with the very largest banks, and I just happened to be invited to the party. And he said the reason that the capital markets are frozen and businesses can't get money is because you're all holding this bad mortgage paper. He said, so I want you banks to buy all the mortgage paper that's out on the market today. And if you hold it for 3 years, then these markets will recover. These bonds will either be good or you'll write them off, but you'll buy them at today's value so you won't take losses on it. You'll market to market and you'll perform due diligence. He said, I want you to buy all those bonds. I think in 3 years you'll make a profit at it.